Go. Hello and good morning. I am Kenny Polcari, your host of the party. And today is Thursday, June 23rd, 2022. And I am at the OSPAM, Palm Beach, Florida, at the First Trust Sales and Insights Conference. And it is a spectacular conference talking about everything from housing, economics, to the market, to recession or no recession. It's all very exciting. But here's what you need to know. What happened yesterday, what's happening today, what did Jay Powell say on Capitol Hill yesterday, and what is he saying today? Right? Yesterday he played the starring role. Is he again today? What did he reveal? Well, he did reveal that rates are going to continue to go up. We'll talk about that in a moment. Investors now have to start pricing in a 100 basis point move in July, at least put it on the radar. Oil under pressure as the global recession fears continue to build. Treasury yields retreat on a bet that the Fed will blink. And what are we having for dinner tonight? We're having the summer risotto, but we'll get to that in a moment. So here's a quote yesterday from Jay Powell, and here's what he said. An economic downturn is a certainty, is certainly a possibility. We're not trying to provoke and do not think we need to provoke a recession, but we do think it's absolutely essential to curtail inflation. That was yesterday, June 22nd, in front of the Senate Finance Committee, and today he's reiterating that in front of the House Financial Services. Need I say more? We don't need to provoke it, but it's essential. And by the way, it's most likely already begun. Today, JJ takes the Capitol Hill again, right? And he's going to tell the House that steep rate hikes could tip the U.S. economy into a recession, right? If he repeats what he said yesterday, he's going to go on to say that navigating a soft landing is going to be very challenging. Bingo! He followed it up with this. The other risk is that we would not manage to restore price stability, which is a risk, and that we would allow high inflation to get entrenched in the economy. We cannot fail on that task. We have to get the economy back to a 2% inflation rate, and ongoing rate increases will be appropriate to cool the hottest price pressures in 40 years. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore need to be nimble in responding to incoming data and the evolving outlook, quote unquote, Jay Powell. So all I can say is ding, 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 here it is, right? He's now opened the door to include a full 100 basis point rate hike in July, right? It's now out there officially in the global public square. It has to be. Investors now have to consider the real possibility of that move as soon as July, and as a result, will and should price that into stocks, right? And if that happens, just like the June 75 basis point hike, then the markets would be prepared. And if it doesn't happen, investors will then have to decide if it was or is a good decision based on all the data points available. Stocks are going to adjust at the pace at which the Fed will now raise rates, not if they're going to raise them, but the pace at which they will raise them. And that could mean further downside ahead as that gets priced in. Is it 50? Is it 75? Is it 100 basis points? That's now the question. Recall, in yesterday's note, I made it very clear. This is a math problem. It's nothing more than a math problem. So when you go from certainty, like 1 + 1 = 2, to uncertainty, like 5 times X equals, that's the issue. You have to solve for X. And the answer is not necessarily 1, 2, or 3. And all that means is that the multiples in stocks in the broader market will come down, which it already has, currently standing at 17.6 times forward 2022 earnings. And that's for this year, and 16.4 times 2023 earnings, which is down from 24.6 times in 2021. So here's the math. It's simple, right? In 2021, we ended the year at $47.66. S&P earnings were about $193 a share, and investors were willing to pay 24 times 6 times those earnings, which gets you to $47.66. But interest rates were zero. There was no alternative to stocks, and if you were searching for yield, right? Treasuries, which are riskless, were offering nothing. Yields were about 1.25%. Savings accounts were earning zero, and inflation was about 1.5% annually. But now inflation is running at 8.6% and going higher. The Fed has started to raise Fed fund rates, taking them from 0 to 1.75% currently and going up from here. The rise in Fed funds causes Treasury prices to come down, sending yields higher, currently now yielding 3.3% and headed higher most likely. Now, these are riskless, so that's great. And you're starting to see that they're offering yield, so there's going to be a challenge to investor money, right? and inflation is going to eat away at consumer behavior. So there is now competition for investors' dollars, and that's putting pressure on stocks and bonds. Investors are no longer willing to pay 24 times earnings because now they have to assess what higher rates will do to the economy, to the consumer, to spending, to demand for goods and services. The question is, can we weather that storm without disruption to economic growth? The answer is not so simple as 1 + 1. Everyone has a different opinion, and at the moment, no one's necessarily wrong because it depends on what number you put in the equation and what numbers you put into that analysis, which is why we have currently Goldman Sachs suggesting that we got 3,100 on the S&P in this latest drawdown, while Morgan Stanley has 3,400 target on the S&P. And that's just for the drawdown. That's not their year-end projections. Those projections are going to be driven by what they think the S&P earnings will be for the year, thus the range in year-end targets. So you got to think about it like this. Analysts now have to guess, using the data that they have available, what they think the total year-end earnings will be in order to produce that target. And that depends on your outlook for the economy in a rising rate environment, right? So you got to see how this works. Someone that has the S&P at, say, 4,800 by year-end 2022 is assuming earnings of $272 a share, right? 4,800 divided by 17.6 times forward earnings, you come up with $272 a share. While anyone that has S&P 4,000 as a year-end target is assuming earnings of $227 a share. Currently, the consensus estimates for 2022 is for 10% earnings growth year over 2021. So that gets us to about $213 a share. Right, $193 last year times 1.1% is $213. Right where the market closed last night. Right, if you look at where the market closed, multiply 17.6 times 213, you come up with 37.48. Exactly where the market closed. But this is a moving target because if the Fed forces us into a recession, then earnings estimates will have to come down as demand for products wanes and earnings come under pressure. Second quarter earnings are due out in 3 weeks. Current estimates suggest that we should see a 4.8% year-over-year growth rate, while it assumes a 10.6% rate in the third quarter and a 10.5% in the fourth quarter. Those will certainly be adjusted in the months ahead. So depending on what they come in at is going to affect the year-end outlook. If they come in stronger than the estimates, say at 5.5%, then targets will be raised and stocks will rise. If they disappoint second quarter earnings and come in at, say, 3.8%, then targets will be forced lower and investors will have to reprice stocks lower. And so, for yesterday, investors choose to march in line, right? They chose to march in line. They need to digest his comments and wait for today's appearance on the Hill to see if it reveals anything new. By 4 p.m., the Dow lost 47 points, the S&P gave back 5, the Nasdaq was down 16, and the Russell lost 3 points, while the transports gave back 146 points. The weakness in transports is suggesting a slowing U.S. economy. Just another data point for everyone to watch. So the confusion continues, and multiples will continue to get compressed as rates rise. It's not complicated, it's just a math problem. All you have to do is produce the correct number, and that's the challenge when you're doing the analysis. Okay, so yesterday the sectors are really mixed. Energy, the XLE was the biggest loser, falling 4%. But remember, it's also the biggest gainer for the year. It's up 32% year to date. Real estate, utilities, healthcare, all ended the day about 1% higher, while everything else, the other 5 or 6 sectors were off small, less than 0.5%. So there was no real additional damage done yesterday. Treasury yields ended the day lower, yielding 3.1%. And that's telling because it tells you that bond investors and traders think the Fed is going to blink, that they will not have the guts to continue down this path of higher rates, to which I say not happening. They are backed into a corner. JJ told you that yesterday, but the bond market is telling you that he's talking out of the backside, right? So both Fed presidents, Barkin and Dudley, yesterday told us that they expect the Fed to be more aggressive on rate hikes, that they expect rates to be higher, certainly by the end of the year, and that falls in line with Bullard, Daly, Mester, Bostic, and Vice Chair Brainerd. Recall, Kansas City's Esther George is the only dissenting voice in the June vote that happened just 2 weeks ago. Oil continues to come under pressure as the recession fears mount, right? And the recession fears are mounting because the Fed is expected to be aggressive, and that's sure to put us in a recession. JJ all but said so yesterday, falling from last week's high of about $120 a barrel to this morning's low of $103.50 a barrel. And remember, rising rates that puts us into a recession is expected to destroy demand for oil and a range of other goods and services, thus the economic concern, which is why you're seeing all the volatility. across the range of these assets, right? Oil is now below its 50-day moving average trend line. It's about to kiss its 100-day moving average trend line at $99.50 a barrel. Depending on what we hear today from JJ and what investors assume is going to happen is going to determine the next move for oil as well as every other asset class out there. Stocks, bonds, cryptos, oil, other commodities, it's all going to be dependent on what we hear Jay Powell say. This morning, U.S. futures were essentially flat, right? Before the opening, Dow futures were down 5, S&Ps were up 7, NASDAQ down 3, the Russell's up 6. Eco data today includes both services and manufacturing PMIs, right? The S&P manufacturing services and PMIs, they're expected to be 53.3 and 56, respectively. We're also going to get the Kansas City Fed survey of 13, that's down from 23 last month, suggesting slowing activity. Initial jobless claims and continuing claims are also a Thursday favorite, right? They're Thursday staple. They come out every Thursday, so not a whole lot of focus going to be on that. Mortgage apps yesterday were in fact up by 4%, which is a bit of a surprise considering the cost of money keeps going up, right? Mortgage rates are now at near 6%. So this might be the last hurrah before the mortgage rates have a 7 handle on them, which I suspect is going to happen by year end, right? So another 3 or 4 months and we're going to have 7% mortgages. European markets are all lower this morning, falling between 0.5% and 1% as flash estimates for German and French PMIs came in weaker than expected. Recall inflation across the Eurozone is running at 8%, 7.9% in Germany, 5.2% in France, 7.3% in Italy, 8.3% in Spain, and 9.1% in the UK. JJ's comments and Christine Lagarde, ECB president's comments, and the recent eco data out of Europe are all stoking fears of a global recession. German 10-year bunds, which is a key metric, falling 21 basis points to yield about 1.4%, as they too suggest that both the ECB and the Fed will blink. In the end, it's all about how the Fed and the administration are going to navigate this. It's about the ECB, the Bank of England are going to navigate this. It's about how central banks from all the major developed nations are going to handle this. The risk of a global recession or a crash landing is rising every day as concerns are rising that central banks will go too far and push the economy into a deeper recession than many had been expecting. So strap in and hold on because there's definitely more to come. The S&P closed at 3759 last night, leaving 3800 as resistance and 3600 as a floor, right, as the downside target right now. Expect to hear lots of chatter about JJ's testimony today, so everyone's going to be listening to his appearance on the Hill. Again, you have to listen to his tone, listen to the questions asked by our elected leaders, because that will reveal a lot about what they understand and what they don't understand. Okay, so what do we have for dinner today? So we're having the summer risotto, right? It's a beautiful day out. Summer now is here. I mean, you certainly see, look behind me in Florida. It's an absolutely gorgeous day here, but this is a great recipe. It's not so difficult to make, and it's always a fan favorite. You can use it as a staple. You can use it as a side dish. You can use it as an appetizer dish. But this is all about the fresh summer vegetables and how easy it is to make it. So it's a range of green and yellow veggies which add depth and flavor. So you should give it a try, right? So here's what you need to do. So for the risotto, you're going to need the basics: the arborio rice, some white wine, chicken stock, fresh grated Parmigiana cheese, a Vidalia onion, butter, and a splash of olive oil, right? In addition, for the veggies, you're going to need some colorful veggies. So you need peas, you need asparagus tips, you need leeks, you need baby zucchini, both yellow and green, right? Adds depth. You want to slice it lengthwise and saute them quickly. You want to add artichoke hearts. You can even add cut blanched broccolini. That's another green vegetable, but it's also very good in this dish. So you want to begin by sauteing the Vidalia onion and the chopped leeks in a bit of butter and some olive oil in a big pot. Now add in the rice. Stir it until the rice is well coated in the butter and the oil, right? Now you're going to add about a half a cup of your favorite white wine. I would use, you know me, Pinot Grigio, Santa Margherita. I would not use a Chardonnay. Allow that to absorb. Next, as usual, you're going to add 1 ladle of hot chicken stock at a time. You're going to stir it until the rice absorbs all the chicken stock, and then you're going to rinse and repeat again until the chicken stock is absorbed and the rice is firm but not hard. It should take about 35-40 minutes. You have to stand there and stir it. When it's ready, now you're going to add the peas, the asparagus, the artichokes, the zucchini, the chopped broccoli if you use it. You're going to stir those vegetables into the rice so that they warm up, right? You're going to add in a squeeze of fresh lemon juice, not too much, just a squeeze, and some fresh grated Parmigiana cheese. You're going to serve it as a starter or as a side dish. Either way, it's always a celebration of summer. The markets are now open. Markets are churning as they listen to Jay Powell. It is a spectacular day here at in Palm Beach at the O Spa Resort at the First Trust conference. Until tomorrow, take good care.